Record retention is really two questions. What kind of record is it, and what tax year is still open? On the EA exam, they'll test your ability to match the record to the right clock. Property and basis records usually live much longer than a normal return. Payroll and employment tax records have their own specific minimum. Don't guess. Anchor to the rule. Start with property records. Basis supporting documents must be kept as long as they may be material to any return involving that property. Translation. Keep them until the statute of limitations expires for the year you sell, exchange, or otherwise dispose of the asset. That's why a 2012 purchase can still matter in 2026. If you sell in 2026, the basis file is still alive. Basis records aren't just the purchase contract. You also keep anything that changes basis or supports deductions tied to the asset. Think improvements, casualty losses, and allocations. And you must keep records to compute depreciation, amortization, or depletion. Exam tip: if you see a fixed asset, your retention period is not 3 years from purchase. It's tied to the disposal year statute. Now connect that to the statute of limitations. A normal return is generally 3 years after the return is due or filed, whichever is later. But there are extensions. 6 years for big omitted income, and no limit for fraud or no return filed. So when a question says, keep until the statute expires, you're really being asked, which statute applies to that year? Employment tax records are simpler. A business must keep payroll and employment tax records for at least 4 years after the tax becomes due or is paid, whichever is later. That whichever is later phrase is the trap. If you pay late, the clock can extend. On the EA exam, when you see payroll records, your default answer is 4 years, unless they give a special fact changing the later date. Use the EA firm example. Chantel is an enrolled agent running a franchise with employees, receptionists, and preparers. Even though the work is tax prep, she's still an employer. So she must keep employment tax records for at least 4 years. The exam loves this because it tests that tax pros don't get a special shortcut. If you have employees, you follow the employer record-keeping rule. Malik is an enrolled agent with 20 tax preparers who work for his tax preparation firm. How long is Malik required to keep payroll tax and employment records related to his employees? The options include 7 years, 4 years, 10 years, and 3 years. Think about it. What's the standard employer rule? The correct answer is a minimum of 4 years. Payroll and employment tax records must generally be kept at least 4 years after the tax becomes due or is paid, whichever is later. A tempting wrong answer is 3 years, because that's the common assessment statute for income tax returns, but payroll records have their own 4-year rule. With regards to federal taxes, the statute of limitations for assessment refers to what? The choices include time to collect unpaid taxes, time to disbar a practitioner, time to charge a felony tax crime, or time for the IRS to assess a tax deficiency. Think about what assessment means in IRS language. The correct answer is the maximum time period in which the IRS can assess a tax deficiency. Assessment is the IRS formally recording additional tax due for a year. The tempting wrong answer is the time to collect, but collection has a different clock. On the exam, tie assessment to the IRS's ability to add tax, not to collect it.